Yes. I won't let Ryan wait any longer. Our start of the week is Groupe Dynamite, symbol GRGD on the TSX. It's a company we do have in coverage, obviously, very recently because it only IPO'd actually last November. And it hasn't been, up until recently, the greatest time for the stock, as you can see here on the chart. Liberation Day was obviously a big hit. As well, we'll get into why the industry as a whole really hasn't been happy in general. But if you don't know, Groupe Dynamite is a growing women's fashion retailer. The company caters to the needs of Gen Z and millennials through its brands Garage and Dynamite. The company operates 297 stores across Canada and the US, as well as online. The split between Canada and US is about 50-50. The company, even though it just IPO'd recently, was actually founded in 1975. And then it IPO'd, just like I said, in November of last year. The stock has skyrocketed, though, since 44% since reporting its fiscal Q1 earnings on June 17th, and is now trading at 23.82 a share. And just for our own client purpose and just to really pump up what we're doing, we recommended this stock back in February at a price of 16.11. So obviously great returns for our clients, and we were really pushing into when it did dip after Liberation Days that our thesis was still intact. So why did the stock actually surge on earnings? First off, we need to recognize the environment not just Groupe Dynamite has been, but the whole apparel industry and really retail, anything consumer discretionary has been at this time. The industry is just exposed to US tariffs more than other industries, and it's just generally weathering poor consumer sentiment. It hasn't completely appeared in consumer spending. You still have slight uptick in consumer spending, but the sentiment is really at an all-time low. And this has really been appearing as well in earnings. So, for example, Aaron highlighted last week, Lululemon's cut to guidance, which resulted in a significant decline in the stock. And that's the direct opposite of what we're seeing here with Groupe Dynamite. But generally, retail and apparel companies have just not had a great macroeconomic environment to operate in, which is why we saw the Groupe Dynamite falling, the stock that is, at the beginning of the year, then sharply on that tariff announcement. It was alongside with the rest of the industry. The entire industry really fell alongside with it. But with the Q1 earnings, we can see that the underlying fundamentals remain strong for the company. Revenue up 20% to 226.7 million. Same store sale growth up 13%. Operating income growth up 16.2% to 44.3 million. Adjusted EPS up 8.7% to 25 cents a share from 23 cents in the prior year. As well, a non-financial metric, which I'd like to highlight, a reduction of by more than 50% of China receipts into the US as a response to tariffs, which was a major concern, not just for Groupe Dynamite, but as a whole, but specifically for Groupe Dynamite, because they did have around 70% of their inventory being sourced from China. So obviously with tariffs shooting up to 140% at one point, that is a major concern, but they've actually pivoted quite well out of China, as well as tariffs have pulled back a bit since then. Further, the company has even an improved outlook as it raised its same-store sales growth guidance to the range of 7.5% to 9%, and that was from 5 to 6.5%, while holding the EBITDA margin range of 30.3 to 32.3%, which shows that the continued expectation of momentum for the rest of the year as they are actually raising their guidance. They're expecting better results, unlike what you saw with Lululemon, the exact opposite where they cut guidance. You're seeing actually improved guidance, which is really an anomaly in this market. So generally, if as a whole, a great quarter with improved outlook in a broadly just poor environment caused a quick snap to the upside for the stock and has been obviously a great return. And for our clients, we will be updating the company in full in the near future. But for now, it is our star of the week.
Yeah, and I think that snap kind of the expectations of weaker results for the sector overall, and then you juxtapose that with results that were actually better than expected, and then the outlook is actually upticked for the year, and that's how you get the recipe for a stock having a significant jump in a short period of time. So nice to see. Worries earlier this year, but I mean the company has been delivering, and if companies deliver over the long term, I mean there is worries of a weaker Canadian and U.S. consumer heading into the second half of this year, but that guidance still is lower same store sales than they saw over the last couple quarters, so they are baking some of that in. We'll see if they continue to deliver again. when we come out with that buy on Group Dynamite, that was not for what they're doing over the next 3 to 6 months. It's doing for 3 to 5 years. And, it's similar to a recommendation we made about 5, 6 years ago in Aritzia. Stock traded at $16 and it's around 67 today. It has not done this. It has not gone in a straight line to 67. It's done this over time. We would expect there's always challenges. It's a volatile industry, retail. But there are a lot of good things we're seeing from Group Dynamite. The balance sheet is relatively strong in the sector, and there could be a dividend introduced in this company over the next couple of years. So that's something we may like to see if there is excess cash, and it looks like they could be heading in that direction. But always like to see that organic growth, and the company certainly has organic growth in tough times.
Well, yeah, and again, like Ryan said, we're looking to hold this company long term. We like the growth. It's a great organic growth story. Um, and when all of a sudden it's pulling back, we're telling clients that they can buy more. You know, just because again, we're seeing looking 3 to 5 years out where this business will be. Well, we liked it at $16. We like it more at 11. So that was very nice, is we were able to get clients to add to their positions in that range.
Yeah, I mean, we'll have this is just an aside, but sometimes we'll have clients or investors who follow our research. If a stock goes up too fast, it's like, well, I didn't have time to get in. And then we have with Group Dynamite, oh, it went lower and I'm panicking. It's like, well, this again, both of those businesses we're looking at, any business is 3 to 5 years out. So if it's a business, as long as the fundamental situation hasn't broken down, and like the fundamentals in the short term were kicked in the groin by Liberation Day, and that caused uncertainty, and there is certainly a reason why, and we understand why the shares went down in the short term. But the fundamental drivers of the business that were likely going to be there over the long term were still in place. So and it's still traded at relatively reasonable valuations. I think it has pivoted even faster than most investors would have thought they could with their supply chain, which is great to see. We'll see how resilient they can be with a weaker consumer, but the numbers are good, and the fundamentals of a business, I like to say, are like gravity, and you can see the gravity was here, and it sucked out to that as those results came out. Or maybe it's like a magnet more than anything.
Yeah,
Gravity was.